Making economic forecasts and stock market predictions can be humbling. It's especially tough when you expect stocks to go higher and get a big drop instead. The environment today is the opposite, but still tricky, as recession hasn't followed the course of predictions. In some ways, figuring out what to do now that stocks have gone up is as difficult as considering what to do when stocks are down. Today's more fully valued stock market is pricing in an increasingly optimistic outlook for economic growth and corporate profits, but the economy still faces challenges that will likely lead to slower growth in the second half, and perhaps even a mild economic contraction. So why stay invested? Hi, I'm John Gigliello, Certified Financial Planner with the Albany Financial Group, and you're listening to Invest in Knowledge, a podcast about all things financial. After a life-altering health issue at age 39, my calling in life became clear: to share my knowledge of personal finance with people who are looking to make smart and responsible choices with their money. Only through education, action, and accountability can you build the confidence and security that you need to live a satisfying life. Now, in today's episode, I'm going to talk about why you should not try to time the markets. First of all, it's difficult to time the market, period. We've seen this play out several times in just the past few years. For example, few foresaw the strong market rebound that occurred as we came out of the lockdown in 2020, or that inflation would become the ongoing problem that we're still dealing with today. We saw it again this past spring. Professional portfolio managers and investors alike were broadly pessimistic about the stock market, particularly in the wake of several bank failures. Yet, stocks have gone virtually straight up since. Another reason to stay invested is recent and encouraging economic data, which supports higher stock prices as the odds that the U.S. economy achieves the so-called soft landing. The U.S. economy grew 2.4% in the second quarter, a solid pace for a typical economic expansion these days. The job market remains healthy with near record low unemployment. A resilient economy has fueled better profits for corporate America than most had expected, setting up a likely end to the ongoing earnings recession in the current quarter. Third, lower inflation may continue to support stocks in the months ahead as the Federal Reserve, or the Fed, winds down its interest rate hiking campaign. The Fed's preferred inflation measure, the core PCE deflator, dropped a half a point in June to 4.1% and could potentially reach the mid-threes by year-end, not far from the central bank's 2% target. Lower inflation may also be good news for bonds by enabling the Federal Reserve to cut interest rates in 2024, as most expect. Fourth is historical comparisons. Since 1950, stocks have gained an average of 40% 1 year following bear market lows. Nearly 10 months since our bear market low, our current bull market is up about 28% so far. Keep in mind, once the S&P 500 has gained 20% off of a bear market low, which it actually did June 8th of 2023, the 1 year average historical gain is almost 19%. We are also in the best year for stocks within the 4-year presidential cycle. In other words, more gains and record highs in the coming year are reasonable to expect. Finally, for those worried that gains in the broad market have been driven by only a handful of stocks, stock market leadership has started to broaden out. We believe that's a necessary condition for the next leg of this bull market. Small cap stocks fared better than large caps in July, and the average stock in the S&P 500 rose more than the index over the past 2 months. For those who may have missed the rally, we would advocate for a dollar cost averaging strategy, which is simply investing at regular intervals over a period of time. This can be a great approach as it takes emotion off of the table. Consider maintaining a cash reserve so you can take advantage of dips that will inevitably come, and use volatility as an opportunity to get back to long-term target allocations. Of course, we always encourage you to take part in the financial planning process to help secure your financial future and, in turn, feel optimistic and proud about your accomplishments. Knowing that I've provided education and a plan for my clients has allowed me to turn a personal challenge into a gratifying journey. Thank you for listening to this episode of Invest in Knowledge, and please reach out to us anytime you have questions. Have a great day, and thanks for listening. John Gigliello is a registered representative with, and securities are offered through LPL Financial, member FINRA SIPC. Investment advice is offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and Albany Financial Group are separate entities from LPL Financial. This material is for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecasts set forth may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. Indices are unmanaged statistical composites and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance referenced is historical and is no guarantee of future results. Dollar cost averaging involves continuous investment in securities regardless of fluctuation in price levels of such securities. An investor should consider their ability to continue purchasing through fluctuating price levels. Such a plan does not assure a profit and does not protect against loss in declining markets. All data is provided as of August 1st, 2023. Any company names noted herein are for educational purposes only and not an indication of trading intent or a solicitation of their products or services. LPL Financial does not provide research on individual equities. All index data from FactSet. The Standard & Poor's 500 Index is a capitalization-weighted index of 500 stocks designed to measure performance of the broad domestic economy through changes in the aggregate market value of 500 stocks representing all major industries. This research material was prepared by LPL Financial, LLC. All information is believed to be from reliable sources. However, LPL Financial makes no representation as to its completeness or accuracy. Bonds are subject to market and interest rate risk if sold prior to maturity. Bond values will decline as interest rates rise, and bonds are subject to availability and change in price. There is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Past performance does not guarantee future results. Asset allocation does not ensure a profit or protect against the loss. For a list of descriptions of the indices and economic terms referenced, please visit the website at lplresearch.com/definitions.